Homeowners insurance has jumped 49% since 2019, while general inflation only rose 23%. Insurance companies are using climate models to justify rate increases that hit every policyholder, even if you've never filed a flood claim or live nowhere near the coast. The reason your premiums keep climbing isn't what you think. Before we dive in, be sure to hit that subscribe button for more valuable content. Okay, let's get into it. The insurance industry claims they're simply following the science, updating their risk models to account for climate change. But here's what they're not telling you. Even if their models are completely accurate, you're still paying for disasters that happen hundreds of miles away from your home. And if their models are wrong, you're paying for phantom risks that may never materialize. Are you serious? Let me show you exactly how this system works and why your insurance bill keeps climbing regardless of where you live or what risks you actually face. Insurance fundamentally operates on risk pooling, where a large group of customers pay premiums, and only a small percentage ever need massive payouts. This works when risks are relatively predictable and spread out over time. But climate change has shattered that predictability, and insurance companies now respond by spreading climate costs to everyone. Take California's recent wildfires in January 2025. The Los Angeles fires alone caused an estimated $250 billion in economic losses, with insurance companies expected to pay out $40 billion in claims. This became the most expensive wildfire in history, and State Farm General alone estimates their direct losses at $7.6 billion. Now here's the kicker. California regulators just approved a $1 billion assessment that will be spread across all insurance customers in the state, not just those who lost homes in the fires. This happens through something called the California FAIR Plan, which serves as the state's insurer of last resort. On February 11, 2025, Commissioner Ricardo Lara approved this massive assessment in Order 2025. 1. The first assessment since 1994. Insurance companies can now pass up to $500 million of these costs directly onto their customers. Companies like Travelers have already received approval to add a surcharge starting January 2026, meaning every policyholder will see about 1% added to their premium regardless of their fire risk. California's regulatory environment follows Proposition 103, which requires insurance rate approval through public hearings. But these assessments represent a workaround that still hits consumers. California isn't unique, though. This cost-spreading mechanism exists nationwide. In Florida, they call it the hurricane tax. If Citizens Property Insurance Corporation runs a deficit, they can levy up to a 15% surcharge per account across 3 different categories. If all 3 accounts need money, that's a potential 45% surcharge on your homeowner's premium. And if that's still not enough, they can add a 2% assessment on all insurance policies statewide, including your auto insurance. Yes, your car insurance can go up because of hurricane damage to houses. Florida also offers wind mitigation credits through programs like My Safe Florida Home, but these savings pale compared to the potential assessment costs that get passed to all policyholders. The National Flood Insurance Program operates the same way with its risk rating 2.0 methodology. NFIP premiums have historically been kept artificially low and haven't covered actual flood costs. The difference gets covered by taxpayers, including those living in areas with zero flood risk. Almost 1/3 of NFIP flood claims come from outside high-risk flood areas, meaning the program already subsidizes flood damage in places where people thought they were safe. Now let's talk about the models themselves, because this is where things get controversial. Eric Anderson, president of Aon plc, one of the world's largest insurance brokers, told a Senate committee that climate change has created a crisis of confidence around the ability to predict loss. He explained that the models they've relied on for decades, which look backwards at historical data, just aren't valuable for a changing climate. This creates a fundamental problem. Traditional catastrophe models rely heavily on historical data to predict future risks. But if the climate changes rapidly, historical patterns become less reliable. So insurance companies essentially fly blind while trying to price policies for an uncertain future. The industry has turned to alternative risk transfer mechanisms like catastrophe bonds to spread these uncertain risks across global capital markets. But these financial instruments ultimately add another layer of cost that gets passed to consumers. Here's where it gets interesting. There's actually disagreement about whether these models get it right. Some experts argue the models underestimate risk. A new analysis by the UK Institute and Faculty of Actuaries found that current climate models underestimate the pace of global warming due to factors like the loss of aerosol-induced cooling. Essentially, pollution has been acting like a hidden sunshade that's masked about half a degree of warming. And as we clean up that pollution, temperatures could rise faster than expected. But other experts argue the models overestimate or misattribute climate risk. Swiss Re, one of the world's largest reinsurers, states that the magnitude of climate change impact on the growth of natural catastrophes in frequency and severity is not explicitly quantifiable yet, whereas property value growth and urbanization are reasonably understood risk drivers. In other words, they're saying the increasing costs might be more about more expensive homes in risky areas rather than climate change itself. This uncertainty puts everyone in a difficult position. If the models underestimate risk, insurance companies could face catastrophic losses that threaten their ability to pay claims. But if the models overestimate risk, millions of Americans pay inflated premiums for threats that won't materialize. The real-world impact already shows up in the numbers as of March 2025. From 2018 to 2023, average U.S. home insurance rates rose nearly 34%, with over 11% in 2023 alone, according to the Insurance Information Institute. Between 2021 and 2024, annual rates for a typical homeowner jumped by $648 on average nationwide, a 24% increase. The First Street Foundation reported that average premiums rose 61% nationwide over the past 5 years. These increases aren't just about covering current disasters. They're about building reserves for predicted future disasters based on climate models. Insurance companies essentially ask customers to prepay for climate change impacts that may or may not occur as modeled. The human cost grows severe. Rising insurance rates directly link to home foreclosures. First Street Foundation's research shows that every 1% increase in premiums associates with roughly a 1% rise in foreclosure rates nationwide. They estimate that a 6.6% jump in annual insurance costs could increase foreclosure rates in affected areas by 6.9%. As Jeremy Porter from First Street put it, the one thing proven to prevent foreclosures is getting so expensive that it's causing foreclosures. Consider this story from California. Darlene Tucker and Tom Pinter received a non-renewal notice from Allstate in November. When they shopped for replacement coverage, one company offered them a policy for $12,000 per year, roughly 6 times their previous premium of about $2,000. They couldn't afford it and said they'd likely have to move. The California Association of Realtors found that nearly 7% of real estate deals in the state fell through because buyers couldn't find affordable insurance. Their Clue reports showed no major claims history, yet they still faced these massive increases. The insurance exodus from high-risk states accelerates these problems. State Farm, California's largest insurer with about 20% market share, stopped writing new homeowners, renters, or condo policies in May 2023. Allstate paused new policies in November 2022. 5 other companies followed suit. These companies aren't just reducing their exposure, they're also non-renewing existing policies. State Farm non-renewed 30,000 homeowners' policies in March 2024, representing their greatest catastrophe risk. When private insurers leave, customers get pushed into state-run programs like California's FAIR Plan, which has seen its policies more than double from about 235,000 in 2018 to over 450,000 by 2024. Florida's Citizens Property Insurance Corps now has 1.2 million policies, nearly triple the number from 2019. These state programs operate with limited reserves and depend on assessments when disasters strike, spreading costs across all policyholders. The foreclosure connection reveals another layer of this crisis. First Street Foundation analyzed 29 flood events between 2002 and 2019 and found that homes outside FEMA's designated flood zones saw foreclosure rates 52% higher on average than those within the zones. This counterintuitive finding occurs because homeowners in official flood zones must have flood insurance, while those outside these zones often have no coverage when unexpected flooding occurs. Take Asheville, North Carolina, once considered a climate haven due to its elevated inland location. Hurricane Helene's catastrophic floods in September 2024 shattered that perception, showing that even supposedly safe locations can face devastating climate impacts. FEMA's flood zone maps include about 8 million properties, but First Street estimates nearly 18 million homes are actually at flood risk, largely because FEMA doesn't consider extreme precipitation events in their mapping. The insurance industry also gets subsidized by taxpayers in ways most people don't realize. The NSF and NOAA have agreed to subsidize the reinsurance industry's climate risk modeling needs through partnerships with the Reinsurance Association of America. These partnerships aim to develop new, risk-related products of significant value to RAA, the insurance industry, and other stakeholders. But it's unclear whether what benefits industry advocates also benefits the public. Meanwhile, some insurance companies report record profits even as they raise rates and restrict coverage. Allstate made $3.7 billion in profit in the third quarter of 2025, more than triple their $1.2 billion from the same quarter in 2024. At the end of that quarter, Allstate reported a 34.7% return on equity. These profits raise questions about whether rate increases truly stem from risk or from profit maximization. The Treasury Department has taken notice, releasing what they call the most comprehensive data on homeowners insurance in history. Their report shows that homeowners insurance becomes more costly and harder to obtain for millions of Americans as climate-related events pose growing challenges. Nearly half of all homes in the United States face risk of severe or extreme damage from weather-related events, according to the Insurance Information Institute. New research suggests that a quarter of all U.S. homes may be at risk of a climate-induced insurance shock. An NBC News analysis of First Street Foundation data found that underpriced home insurance presents serious risk in more than half of U.S. states. When climate risk gets properly factored in, 1 in 4 American homes may be overvalued. First Street Foundation has dubbed climate the sixth C of credit, adding it to the traditional lending criteria of character, capacity, capital, collateral, and conditions. Lenders start factoring climate risk into mortgage decisions, potentially creating new barriers to homeownership in risky areas. First Street estimates that lenders will lose $1.2 billion in 2025, rising to $5.4 billion in 10 years as they absorb costs from mortgage defaults linked to climate impacts. The question facing policymakers is how to balance legitimate risk pricing with affordable insurance access. Some argue that proper risk pricing will encourage better land use decisions and climate adaptation. Others worry that climate-based insurance pricing will create a two-tiered housing market where only wealthy people can afford to live in desirable but risky locations. Consumer advocates argue that some cost-spreading mechanisms violate the law. Consumer Watchdog claims that charging policyholders for fair plan assessments is contrary to the law because statutes require insurers, not consumers, to participate in losses. But insurance companies counter that they must price policies to reflect actual risk levels, and California's unique regulatory environment has kept premiums artificially low relative to risk. What's clear is that the current system socializes climate risks while privatizing profits. When disasters strike, costs get spread across all policyholders through various assessment mechanisms. When profits are good, they flow to shareholders. This creates moral hazard where insurance companies have incentives to overstate risks while customers bear the costs of both actual disasters and risk model uncertainty. The path forward requires difficult choices. Should insurance accurately price climate risk, even if it makes housing unaffordable in risky areas? Should taxpayers continue subsidizing development in high-risk locations through programs like the National Flood Insurance Program? How can we ensure that climate adaptation happens without creating massive social inequity? These aren't just technical insurance questions. They're fundamental questions about how American society will adapt to climate change and who will bear the costs. Right now, the answer seems to be that everyone pays, regardless of their actual risk exposure, through a complex web of insurance mechanisms that most people don't understand. The 2024 global insured losses from natural disasters reached $140 billion, making it the third most expensive year on record. With $27 billion weather events in the United States alone costing $182.7 billion, and the first half of 2025 already showing $100 billion in global insured losses, the trend clearly points upward. As climate models continue evolving and insurance companies adjust their risk assessments, one thing remains constant: the costs keep getting passed down to policyholders. Whether those costs accurately reflect your personal risk becomes an increasingly expensive question for American homeowners to find out.